Hi, I'm Samir Jain at Active Allocator. Our clients often ask us if alternative mutual funds and replicated indices provide a tool to hedge against market volatility or whether they enhance returns by managing downside while meeting needs for transparency and liquidity. So these liquid alternative funds have been around for the past 5 years and they seem to be gathering momentum. They are a staple now, having started off as a poor man's hedge fund to gain exposure to long-short equity, multi-alternatives, currencies, market-neutral, managed futures, real estate, energy, commodities too. So investors who do not meet the minimums for accredited investor or qualified purchaser status consider them as a means to allocate to getting hedge fund-like strategy exposure. Hedge fund-like strategies with the liquidity, transparency, and the regulatory oversight of mutual funds. Asset managers too seek opportunities where growth fees are sustainable in a challenging revenue environment. So now we see investors are re-risking, but with an eye for yield, uncorrelated asset classes, and of course risk-adjusted returns. So liquid alts are available to retail investors with an average minimum investment of $5,000, while hedge funds are only available to accredited and qualified purchasers with minimum investments generally ranging from $250K to $1 million. These are regulated by the SEC in the same way as traditional mutual funds. And I think that the biggest opportunity for product development still remains for the retail channel. One reason is affluent retail investors have just 4 to 6% in alternative investments versus a typical 15 to 20% level for institutional investors. Also, everyone is clamoring for fee reduction by moving towards passive investing, as most actively managed funds haven't done too well after fees. So competition for shelf space too is growing. There are well over 1,000 fund products now gaining various degrees of traction, mostly driven by Morningstar ratings, though most are still unrated because they have limited track record. They tend to be mostly placed in portfolios by FAs who use them for improving diversification, enhancing returns, building portfolios with less correlated exposure. The problem is many FAs lack clarity about how alternative strategies fit into client portfolios, which creates an obstacle to adoption. This of course can be addressed by educating the distribution channel, something that we attempt to do at Active Allocator too. In fact, this is an attempt. Wirehouses and RIAs offer the largest opportunity, and the reason is in places where you have top-down centralized decision-making, model portfolios that can be rolled out en masse, one would expect greater adoption. Also, alternative asset managers with brands and diverse offerings are either beginning to sub-advise or launch their products too. Firms are building capabilities through new teams, seeding new products, and in many cases buying or expanding capabilities via M&A. Do keep in mind that despite the claim of these being hedge fund proxies, these are at the end of the day long equity market directionality. So since these are hedged, if you have a bullish market, one would expect slower adoption. The majority of fund sales seem to be financial advisor driven. But now with the convergence of alternative and traditional products happening, they are likely to also find a home in multi-asset and target date funds, in defined contribution, 401k, in institutional portfolios. Addressing investors' liquidity concerns Two can be a catalyst that will drive the next leg of retail adoption, because advisors list lack of liquidity as a top reason to not invest in alternative investments. So as I said, educating advisors on product offering is an important way where managers can collaborate with research departments and drive much higher advisor implementation. Broker-dealers too can play a key role in speeding adoption of target allocations via manager selection, providing due diligence support. So all in all, I tell my clients that this segment of the industry is something to keep an eye on, as it's going to grow plenty fast. And for us at Active Allocator, while we are product agnostic, the exposures that we create can be fulfilled in many ways by alternative mutual funds for the hedge fund bucket. Thank you so much for listening in. Do visit our website where you'll find a lot more information, and I hope this has been useful. Bye-bye.